We're starting to see a massive pickup in the amount of debt that's being taken on by these big companies. In fact, the amount of investment grade debt that's been added this year absolutely dwarfs any other year going back to 2015. It's absolutely phenomenal, the amount of debt that's being piled on. And what's even more interesting is a lot of this debt is getting put in special purpose vehicles so that it's not actually on the balance sheet. For instance, Meta did like a $20 billion SPV, so it doesn't show up on their balance sheet. So it looks like Meta doesn't have any debt, even though they have debt outside of their balance sheet. But we're seeing this big ramp up in debt to facilitate the expectations for AI, the build out of these data centers. There's a tremendous amount of this market that's riding on the expectation that all of these deals that are being done between NVIDIA and Oracle, Nokia and Meta and everybody else is going to actually work out at some point in the future, and the revenues are going to be there.
Prior to about 3 months ago, the industry was sort of self-financing itself. But recently, you've seen some big deals. Google and Meta coming to the market with huge deals to borrow money. And OpenAI apparently has been looking for government backing to borrow money. So the self-financing within the industry may be drying up. NVIDIA seems to have plenty of cash flow, but some of these others is drying up. And now they need to go to the capital markets. It's more rigorous and it's costlier. That changes the equation a little bit, but it also maybe tells you that the cash flows from some of these companies or expected cash flows may not be as much as they think they are indirectly.
Here's the graph that I posted this morning, which was showing that 2.9 trillion of global capex on data centers by 2028. But here's kind of the interesting commentary behind that chart. Meta's hidden AI debt using SPVs. Meta's parked $30 billion in AI infrastructure debt off its balance sheet, which is kind of echoing a little bit of that Enron style financing that we saw back in 1999. On the industry-wide leverage, Morgan Stanley expects $800 billion in off-balance sheet private credit deals by 2028. UBS warns AI debt is growing at about $100 billion a quarter. And so this is going to be kind of one of the new fields for private credit markets, where they're going to be the ones that are providing the debt for these companies through special purpose vehicles. So Meta goes, hey, I've got a clean balance sheet, I've got no debt, but it's all sitting in these special purpose vehicles through private credit markets. So if something blows up, it doesn't necessarily impact Meta as much as all the private credit lenders that took on that risk.
These are the type of deals we're seeing, like NVIDIA and CoreWeave and NVIDIA and OpenAI, where NVIDIA is actually buying a piece of those companies. And in exchange, those companies are buying chips. But it's not one for one. It's not this direct relationship. So it all works. It's financing in a different way, but it can lead you to trouble. And we saw this in the late 90s.
Catch me daily on The Real Investment Show. The link is in the description.